The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.
Well, I was hoping that I would not have to say this week, but we put a 3 handle on the corn market on spot corn futures a few times throughout Friday's session. Just the bearish way continuing in these markets. What do we need to think about? What do we need to keep in perspective? Well, we're going to talk about that and more here today on Market Talk. Joining us for a conversation, pleased to have him back on the show with us. Jim Emter with Vanna On and Company is joining us here today. Jim, it's good to talk with you again, sir. Thanks for joining us on the show. Hope you're doing well.
Thanks, Jesse. All good here. And like I said, we appreciate joining you here today.
Well, thanks for joining us. Definitely. So let's kind of take a 1,000-foot view at this grain market to start. And of course, kind of the headline on Friday is that we threw a 3 handle on the spot corn contract, which I know a lot of producers are just probably groaning as I say that. It's been a pretty tough environment here the last couple of weeks, really since the beginning of the year. I just feel like these markets, the funds have just been stomping on these grain markets and continuing the downside pressure. I mean, your perspective, kind of 1,000-foot view here in the grains as we look at things wrapping up the week.
Well, let's start out a little history. So we talked about that 3 handle being put on corn. This is the first time on the continuous charts since November 9th of 2020 that we will print a 3 handle on that corn market. So, I mean, that's going back some time. That is post-derecho as the market was trying to digest that. Since that time in November 9th, we have not been back below the $3 mark, really $4, we should say, in that corn front month contract for that extended period. So this has been a number of years of good prices for our producers' sake. Cattle and hog guys will argue, hey, we had to endure that. So again, we kind of see this coming around circle where they'll get some benefit out of this. But when we look at that big view of these markets, we've got to realize that we love saying the trend is your friend. And when you see a market that continues to capitulate upon each other, you've got index funds, you've got managed money that see little interest. You've got a market that continues to back away from Fed comments to say, hey, maybe it's going to be summer, maybe it's going to be fall before we see that interest rate change. So again, that catalyst of outside influences just really doesn't support the corn market right now. And then when you dig into the S&Ds, you look at the charts and you look at that managed money flow as a conjunction along with the seasonalities, and we just don't have a lot to grab onto. I mean, the best opportunities were between Thanksgiving and Christmas this year, whereas usually we see that opportunity from Christmas into that February timeframe, fade off here to March 15th, and then try to build back off of that. But Jesse, I think we're in an environment where let's go find the low, let's get as low as we need to get to, and let's get this over with. So that way, again, we can begin to look at some stability in the market, because until we can print a base bottom, there's impossibilities to measure off of. You can't really go off any numbers here on recovery points, and it's just down until we're done. And the concern is we keep going down and no new export business comes in on a major token. So that's the caveat. Usually just like the cure for high prices is high prices, generally the cure for low prices is low prices. But where are we getting that boost of demand that all of a sudden gets people to say, hey, maybe we're not a 2-1-2-2 carryout, maybe we're a 2-1-9 carryout. And those are the catalysts that bottom market. So that 10,000-foot view, that big perspective is, hey, there is not a lot of bull news around. Argentina is going to have a boomer of a crop as it appears. Brazil, while production is going to be down versus the early start of the year, this is still going to be the second largest crop. So, and with demand a little bit suspect as we work ahead from other countries as they go elsewhere, it's just not the setup, and the 10,000-foot view is bearish, and that's why we see markets that are fading here right now.
Yeah, no, great perspective on that, Jim. And I think about this too. You mentioned going to find that low, and I don't think we've found it yet here. And I say that because, we saw a little bit of a short covering rally earlier in the week coming out of the holiday weekend, and that was quickly sold. It felt like some producers took advantage and sold that rally as quickly as it came earlier in the week. And now here we are pushing lower again. So it just feels like that until we really find that low, to your point, We might have a few short covering rallies here and there on news blips, but until we hit that low, man, oh man, it just feels like this bearish trend's going to continue, Jim.
Yep. And, like I said, I think sometimes as analysts, we get guilty of trying to drum up the story. Hey, we're down, so we got to paint all this bear information. That makes people very bearish as we get to the bottom of the market, a lot like it does towards the top of the market. Boy, everything's bullish. It's hot. It's dry. It's this or that. So we've got to be a little bit cognizant of saying, hey, okay, we're getting near an area of support. I don't think corn's going to zero, nor do you, Jesse. At least at this juncture, after crude oil went negative 42 in COVID years, it recaused our thinking a little bit of what markets can do when people are trying to get out. But with funds so short, there's two big things that I really want to focus on that can give us at least a base of support. And then after that, we're going to need a spark. And those two things are, number one, we need this farmer selling to wane off a little bit. And what is the problem right now? Well, March futures are coming into first notice next week. So anybody that's got basis contracts, anybody that's paying storage, anybody that's looking at their interest costs and saying, hey, this is starting to add up, is saying, oh my goodness, you've got me over a barrel. It's time for me to just puke out, and I'll try to own it back if the market starts to recover. And that's an attitude. A lot of people miss that opportunity because they're not structured in their discipline. But, that's really the feature that we're looking at here is we've got to get past this March expiration. I think that can be point one to at least creating some stability around the market, because I think there are, like you said, on rallies, farmer selling that's occurring. The second thing here is achieving price counts. So we know that $4 is an important level. $11 in beans. We don't spend a lot of time between 11 and 12. We either go down to the dumps or we get it back above 12. If we look at price counts right now, the next price count for March corn is 382. If we look to beans right now, you've got $11 and then 1068. So to me, those bigger counts are 1182 in March corn, that 1068 in March soybeans. And if we go out to the next month, just add the carry to it, and it's going to put you in a perspective. If we can get past the March contracts, find a base into that area, that can gain some support. But to rally out of here, we need a spark in South America, dryness in safrinha corn country. We need a boost of demand, or we need spring problems in the U.S. planting. Without any of those three, and we could add Russia, Ukraine, but that story just seems to be dragging on, so that kind of gets pushed off to the side. Big deal over there, but nothing imminent right now. Those are the stories to get a spark, but first we need the base, and to get a base, I think we need the two sets, and then we need a spark after that to get a rally.
To your point about the farmers selling, that's a great point you raised there as well. I think we've seen a lot of farmers have been rolling into the carries in these contracts. And to your point, they're finally just kind of at a point where, all right, I just got to puke out of this thing and take what is there and look at some re-ownership, because I just think it's at that point where you've rolled so much that you're kind of up against it in this window, Jim.
Well, yeah, I mean, anytime you come from a market, I mean, you think of inverse markets, that's the hindrance to marketers is when you get those inverse markets, hey, I'm selling at a great price here, but I don't like that new crop price, or I don't like, that opportunity. So we've transitioned over the last really 7 months from an inverse market to a more solid carry market. And then we come in here on any basis contracts they've had or unmarketed grain. And yes, you're running into that circumstance where, yeah, we had some good basis levels last summer, but that kind of rolled over here into harvest and having a better crop. Basis generally staying neutral to widening. And, you start rolling out those contracts, at 10 to 20 cents a pop. All of a sudden you're looking at a price that's not attractive, and you're looking at least May, if not July, on 2 more carry rolls. And so again, I agree, Jesse. It's causing that flush of grain. Let's stop it. I'll try to own it back. Either way, they're going to have to try to manage that carry and be disciplined. I'm just saying, to really get a spark here, we need one of those 3 bigger stories to happen, either in China, the U.S. front in spring weather, or a safrinha South American story.
We're having a conversation today on Market Talk with Jim Emter from Van On and Company. Jim, as we look at these grain markets a little bit too, I'd love your thoughts just as we get set, thinking about some of those different news stories here. Spring planting's right around the corner. We got fertilizer to think about. We're setting crop insurance prices as well. I think that acreage conversations, maybe another one I could throw in there with you, and some of the things we're going to watch coming up here. And you're in Minnesota, spring wheat country. I mean, one has to wonder, how much could this acreage battle shift over the next couple of months and maybe play into these markets one way or another? Jim, what do you think about that?
Well, I think it's occurring. I mean, I think the outlook for them actually is going to look back and say, hey, we hit the nail on the head with 91 million acres of corn. We were of the mindset that corn wins the game at the end of the day with these high land rents. But, as producers sit down with bankers and look to some of the cash flow and the origination and expenses and whatnot, it may be a little different outcome with these prices continuing to sag here at this juncture unless something changes by spring. So at 91 million acres, a 181 trend line yield, I would argue let's start with 178 and let's prove that we can get something bigger than trend line. But again, if we start looking at those numbers, okay, we're 2.2 to 2.5 billion bushel carryout. Okay, hey, that's manageable to where if we get some crop scares, we can get up back near $5 a new crop, and that fits. So I'm hoping that 91 million acres comes into scope. We start getting up to 92, 93. I think that becomes even more problematic for corn. And so that's the foundation where I think, hey, we settle in there. As you look to the soybean complex at 87.5 million acres, I think that's a circumstance too where with these lower prices, I'm not sure what they're going to go to, whether it be sorghum, cotton, some of these other base, crops. But when you look to the bean complex, maybe some more available switches that occur there, some specialty crops, some seed beans versus regular beans, just trying to look to drum up those premiums. And that creates a situation where 86.5 to 87.5, I still think fits in the mix. As for the spring wheat, it takes a pretty big rally to get these guys to cash flow in spring wheat. So a lot of those are based off more rotational scope things, but we already know winter wheat acres were about 1 million less than forecasted. Could spring wheat follow that trend and be less than forecasted? Again, these crops got to go somewhere, Jesse, because farmers just aren't going to let it set aside unless we have some PP circumstances. But yes, I do think we're starting to gain some confidence in 91 million corn, gain some confidence on around 86.5 to 87.5 soybeans. And, I think that wheat market, especially with some of the weather trends long term, let's not forget, we're in a super El Nino coming off that right now. A lot of meteorological trends are forecasting La Nina by summer. If you overlay years similar, if we follow that pattern, again, we struggle to forecast 2 weeks out, let alone 4 or 5 months out. But if we come to circumstance with a super El Nino to La Nina transition, it could spell hot and dry after about June 5th, June 10th on that front. So a wet spring, hot, cool, we'll see. But some coolness in Alaska has got my attention for next week that could shift down into the U.S., create that spring story, and then the follow-up thereafter, hot, dry, it could get interesting. But again, I'm trying to just say that's a base pattern to our clientele. We can't forecast 2 weeks out, let alone, 4 months out. So please, that's a general trend. Take it with a grain of salt. But we've got to be aware of that because usually we see 1 or 2 good rallies within a growing season. And we just got to be mentally ready for that.
No, that's a good thought. Good thought for sure. And I think too, not getting into specific recommendations or things like that, but to something you kind of mentioned earlier, having a plan. There are tools in the toolbox that you can use in this window here. We may not love some of these prices we're looking at, but there are opportunities out there. And talk to someone, right? Talk to a market advisor such as yourself and try to have a plan in place to manage your risk and manage your operation. I think we have to be smart marketers in an environment like this, right, Jim?
Yep. Well, and 100%. And that's the big thing is, a lot of doom and gloom is around the market, and that's what happens near bottoms of markets. So that's the reality of what we're in. But there's a very important statistic we need to come back to. We talked about it last year, and at times we got beat up over it, but ultimately it came, to fruition. It's come to fruition, 20 years back in both the corn and soybean market, and that is being ready to implement that plan. You can have a great plan, but if it never gets implemented, that's where the fault is. A point we want to make is, hey, generally on average, over the last 20 years, we've been able to get 20% over the February crop insurance price, 16% over the February crop insurance price in corn and 14% in soybeans. When we look to that foundation, if we even start looking at a 10% boost, that takes us up near this $4.97 area, $5 level for new crop corn. I can imagine if we get there, Jesse, there's probably going to be something bullish around that might get a producer to freeze and say, oh man, it's hot in my backyard, or it's hot in southern Minnesota, hot in Iowa, dry in Iowa. Maybe I should step back. I heard on the radio now that people are getting bullish. That's where the discipline needs to come in. So, I think those are important points. 16% over on average that corn spring price, 14% in soybeans. I'm trying to use 5 to 10% over and tell guys, hey, how does that fit into our technical price counts? And let's be ready to market into it. But it's that action plan that matters at the key time. And I think that's going to come usually when most producers are busy. So.
Yeah, no, very good perspective on that. Jim, we should touch on livestock real quick. I know cattle market, good, strong gains on Friday ahead of the cattle on feed report. I know we don't have those numbers in front of us quite yet here, but a pretty good end of the week there. And hogs, too. Summer hogs putting some 100s on the board here this week. So, on the flip side, it's pretty positive over in the livestock sector right now for our cattle folks and our hog producers. I mean, any thoughts or notes you're keeping an eye on there in the livestock trade, Jim?
Well, I think, first off, let's talk feeder cattle and live cattle. It wasn't too long ago, about a month and a half, 2 months ago, that the same doldrums that exist within the grain market were the cattle market. I mean, we were talking about, wow, the tops are in, is this market ever going to recover? We're 2 standard deviation from linear regression. Why is this getting so ugly with supply structures that maybe are a little friendly? Oh my goodness, the economy might fall apart. So that's why, again, the whole emotional roller coaster existed there. And now we find ourselves, 70, 80% retraced at this point in feeder cattle, live cattle. We're nearing second and third price counts. Again, those cattle on feed numbers are anticipated to be a bit friendly, showing continued supply concerns over the next year and a half, but more imminent. The cattle on feed report focusing on just this segment right now. I think we just got to bottle that all up and realize that, again, there's unforecastable things with our economy that even our Fed doesn't have a clue on right now. They know they need to be careful lowering rates. They know they don't want to raise them anymore because the pain it brings. They're trying to float into the soft landing area. I just think we've got to realize, with us trading second, third price count showing significant retracements, I think that feeder cattle market is the first one to maybe have a volatile 10 days ahead, try to create more of a structure of a topping type market, and then begin to struggle a bit more. So I'm really encouraging feeder cattle producers to make sure you've got that foundational floor in there, whether it be the crop or the cattle insurance or an option, put option, or a sale with the call. I can't get into too many details. Understand your margin risk, past performance not indicative. We've got to do all that, but just make sure you've got a base, because there's your opportunity. You've had, rougher years, high grain prices. Now you're coming into your prime. You can get some coverage in corn. You can come in here and get feeder cattle covered up into those price counts, even live cattle. June is into a gap fill area. We've got foundation around that in regards to opportunity for profits. Just get a floor underneath yourself. And a lot of these gaps, it took some time to get back to. We've got gaps in corn and beans, that are a buck higher right now in beans. And so we got to keep in mind, cattle may have given us an opportunity to see how grains can recover down the road. But in my opinion, the cattle guy, it's time to get covered, and out there at $100 hog prices there too. Find some risk management ways to get a floor underneath yourself, allow for that upside potential, because again, we've made some nice recoveries and we're getting into price counts that I think are a little bit edgy as to, yes, we got a supply story, but that demand story better stay strong or else we can fall apart pretty quick.
Well, I'll add to that, the risk of trading futures and options can be substantial, of course. We want to remember that everyone's operation is different. And great stuff, Jim. Really, really appreciate the conversation. And, final thoughts from you real quick. We covered a bunch. Lot to think about over a long weekend and get into the end of the month here in February. I mean, what would you reiterate to producers? So what do you want them to remember in this window across the board, Jim?
Well, I think just remember that emotions can run high, and oftentimes emotion running decisions can really impact, the bottom line. Look at those bottom line circumstances, set and be ready for a marketing plan as we work ahead. I think we're going to get 1 to 2 good opportunities as we work through spring and summer. I don't know what those will be right now, Jesse, and everybody's struggling to find that bull spark. But when we find it, with funds probably record short after today with the commitment of traders this afternoon, we'll see where it comes in. With everybody leaning hard one way, the producers are so long. I just want people to be ready, realize that circumstances can change very quickly, and defend decisions. I mean, if you're making a decision right now that's not profitable, you better have a plan on how to make sure you cover it in case something changes. And that's the big thing we're stressing to producers. We've got good percentages marketed. That's great, but we still got work to do, 24, 25, and years ahead. We've got these dynamics to work through until something significantly changes. So work on that plan, implement it, and then defend it when needed.
Jim, if folks need some advice to work on that plan with, and they want to reach out to you and the team there at Van On and Company, how can they get a hold of you guys, Jim?
Give us a call, 800-648-5494. We've got a great team here of 18 licensed brokers, or check us out on the web, www.vanonco.com.
Jim Emter with Van On and Company. Jim, great to talk with you again. Thanks for joining us on Market Talk. Look forward to getting you back on the show again in the future. Appreciate it.
Thanks, Jesse. Always appreciate it. You guys do a great job.
Thank you very much. Jim Emter with Van On and Company. That's going to do it for the show. Find us at markettalkag.com. I'm Jesse Allen. Have a great afternoon.